got a tough job here. I've got 15 or 20 minutes to present to you the findings of the Northern Beef Situation Analysis. This is the second Northern Beef Situation Analysis, and I was privileged to be a co-author of both of them, but I think this second one is by far a better study. To MLA's credit, they commissioned this analysis, and it's meant to be a snapshot of where the northern beef industry is at the moment. And I'm afraid the bad news up front is that it's not in good shape. So we broke the north up into the regions used by ABARES, and there's 14 of them there, and we've reported on all 14 regions. We've taken 12 years of data going back from those regions, aggregated them into 4 3-year blocks, and looked at the change over time. And interestingly, over time, the overall level of profitability of the industry in the north in that 12 years has declined with each break of 3 years. When we decided to analyse the data and write the report, we decided that just reporting on profit and profit alone without reference to any framework would be not the way to go. So we developed a framework that we could hang all the results on to come up with some meaningful findings and recommendations. And we decided to take an economic sustainability approach where we could say if a business ticked all these boxes, we could be absolutely certain that it was economically sustainable in the long term. And so defining those criteria, we came up with 8 of them, and a lot of economists and academics have had a look at those criteria since the report came out, and yet so far nobody's able to find any problems or serious flaws in them, so they're confident that they're okay. The first one is that a business must generate a business return that's better than the cost of capital. So the cost of capital is just the cost of debt, and it's quite simple and predictable. If the business isn't generating a return greater than the cost of debt, ultimately equity is going to be eroding. That's the first one. The second one is that all of the operational expenses and operational capex have to be funded by that business's operations. In other words, if you have to go to the bank to fund your day-to-day operations or capex, that business is unsustainable in the long run because that funding may not always be available. The third one, and this is contentious, so the business has to remunerate the owners adequately, and if it doesn't, if the owners are drawing a small amount out of that business and propping up that business through a lifestyle choice, over time that wears pretty thin with people. And so we chose the yardstick as being the average male and female wage earner. And this may surprise many of you, but this is the average worker in Australia at the moment. You combine the average pre-tax earnings of males and females, they add up to $150,000. This is just the average worker. And we've taken the position that if a farm business cannot afford to pay its owners, at least to that standard, the business is probably unsustainable in the long run. There are some issues with non-cash benefits of living on the farm, but I haven't got time to go into those now. It must maintain a safe level of equity, and the sad fact is we found that the average business in Northern Australia, family-owned beef business, cannot afford to have any debt whatsoever. None, zero. Because it hasn't got the capacity to pay the interest and then do all the other things that are needed. So for businesses that are a little better than that, you can't afford to let equity slip below 85% for very long, otherwise the same problem occurs. Interest is consuming too much of the cash flow. Have the capacity to repay debt in a timely manner. We go into this issue in some depth in the Business Edge courses that MLA run, that I'm involved in with Ian McLean. And the explanation here is that it is not the cost of the interest cost that's the true cost of debt. The true cost of debt is how long that debt's outstanding for. So if you've paid a debt off in 5 years, the total cost of that debt's going to be a heck of a lot less than if it took you 20 years to pay it off, simply because of all the interest going out the door and into the bank. And we suggest that a business carrying any debt must show the capacity to pay that debt off within 10 years. These next two are linked, and they are business dependent, but if succession is an issue, then independent retirement becomes an issue too, because succession is not complete until the older generation are gone and living an independent retired life. Both of those issues, if they are relevant, require an enormous amount of funding, and for both of them, unless the provisioning for that funding begins early in the life of a new owner or manager, there's not enough time to accumulate the funds needed. If you wake up at age 55 and say, oh, succession and retirement's 10 years away, I'd better get busy, you've got no chance of getting there, none. It's got to start early on. And finally, and not because it's the least important, we took a zero tolerance attitude to the erosion of environmental capital. If environmental capital is being eroded to prop up the financial capital of the business, in other words, if you're having to flog the place to keep it there, it's totally unacceptable. That's the only measure that we couldn't get a handle on in this last Northern Beef report, but should there ever be another one, we now know how to do it and will be able to concurrently measure whether environmental capital is being eroded at the same time. From other work and other stuff that I do, I have the firm view that Northern Australia, as a broad sweeping statement, Northern Australia is overgrazed, and there is evidence that environmental capital is being used up. So when we applied all of those yardsticks to the data that we were analysing, we came up with a figure that only 20% of family-owned businesses in Northern Australia are economically sustainable at the moment, and that percentage has been falling over time. That's all the bad news. So that's the first finding. Too many businesses lack operating scale. There's just too few adult equivalents running around to absorb all the costs. The average herd in Northern Australia has abysmal herd productivity, despite 40 years of R&D and findings on how to fix that. It's not been taken up, and the productivity is not good. Most producers don't understand the key profit drivers, and the reason we concluded that was that there's no evidence that the key profit drivers in these businesses have been improving over that 12-year period. Next to no understanding of prudent debt management, and I'll leave that for a moment and show you some data on that in a moment. Financial illiteracy, a simple understanding of how the finances of a business work and the associated business skills come together is seriously lacking in the north. Poor capacity to manage climate risk. Failed seasons are costing too many northern businesses too much money because they're not being managed properly, and there was evidence of that in the data, because in that 12 years there were a number of dry years, and the degree to which those dry years set those businesses back was, I believe, unacceptably high, because there's no firm understanding of the most economic way to deal with a failed season. Inability to embrace technological change, and essentially it comes down to attitude. So this didn't come out of the report, but when we sat down and tried to explain why all this was the case, it seems that out here on the right you've got those 20% of businesses who are wanting to be economically sustainable, are profit-focused and profit-driven and understand what they need to do. Over on the left are the lifestyle people who are more interested in talking about choppers and road trains and all that sort of stuff and don't really want to know much about the business. And in the middle there's a whole lot of people who want to move from that lifestyle type attitude through to running a profitable and sustainable business. And they're the ones that have to have the attitude change, and that's all it is. We've got all the technology, we've got all the understanding and all the work we need to be able to do that, provided the attitude is there in the first place. So there's the bottom line across all the data for all the years. And you can see that there is a general decline there, but there's a significant difference, five-fold difference in the bottom line, profit per adult equivalent between the average and the top 25% businesses. And as big as that difference is, neither of them are good enough. There's not the time to go into this afternoon, but the target that you need to be sustainable in the long term is $90 per AE, not 50 or whatever, it's 90. And that is relatively easy to achieve. Now, the big picture problem is productivity. That we have to get the land, the people and the herds far more productive than they are now. I won't go into the land and the people, but the herd productivity has to jump up significantly to get more kilos of beef being produced per AE to produce that $90 bottom line. The rate at which the northern beef industry has been doing that since 1978 is only at 1% per annum. We've improved total factor productivity over that period by a compounding rate of 1% per annum, but the problem is our terms of trade, the gap between prices paid and prices received, that gap's widening at 2% per annum long term. So there's a 1% deficit, and this is where the good news starts, because making up a 1% productivity deficit is just so dead set easy if you've got the right approach to it. So our business about our conclusion about debt management not being prudent and in some cases completely non-existent, that goes back to 1978, and just concentrate on the top line there. That's the land prices for the Northern Australian rangelands, and they're expressed as an index value. The other two regions are the high rainfall zones around Australia and the wheat belt. But this madness that's turned out in retrospect to be a classic real estate bubble, this absolute lunacy that happened there beginning in about 2002, caused this. There is the graph that we've pulled out from our work showing what's happened to debt in response to those land values. Too many people didn't have the discipline and the rigour to stand on the sidelines and let that bubble blow up while it was blowing up. They thought that unless I get into this and be part of this, I'm going to miss out, so let's get into it. The banks were complicit in that. They relaxed their lending standards and often threw money at people. They're paying the price now, just like the people who took on too much debt. And so it was a classic madness of the crowds thing, people getting dragged in, but the astute business-focused people stood on the sidelines and right now are sharpening their pencils, getting ready to buy, which I believe is going to be, it'll be absolutely ripe in another 3 to 4 years to be able to step in again. Now, we looked at what we thought was the typical herd size that represented Northern Australia, and it had between, in that 1,500 to 5,500 head. So smaller than that wasn't really representative, bigger than that was representative. And this is more good news here. We applied the economic sustainability criteria that I mentioned earlier, and we were able to split that whole herd size up into those that were unsustainable, which we'll call typical, and those that were sustainable, the top 25%, and there's all the physical features. Now, I cannot see any significant difference between those two groups at this stage, just on those physical features alone. If we look at the financials, going from gross profit right through to EBIT, earnings before interest and tax, so $40 versus the $90 figure I came up with earlier, it's starting to become apparent, and these guys are getting there by more income, slightly lower expense, direct expenses, lower overheads, so their total operating expenses are $20 lower. The whole thing is adding up to a significant difference on the bottom line. Why and how is that happening? First of all, there's no difference in price received. When we looked at all the data over all the years, price received per kilo of beef has a zero correlation, absolutely no correlation whatever with bottom line profit. It was not a profit driver and should be totally ignored. Significant difference in cost of production, and one of the first ports of call for everybody is to use the MLA cost of production tool to work yours out, because that is a major profit driver. A difference here in herd productivity, kilograms of beef being produced per AE, of only 17 kilos. Now just remember that figure, only 17 kilos, and there's about another 200 AEs being run per labour unit. There's the graph to show the evidence that there is no difference between price received along that axis and the profit up there. It's like a shotgun pattern, no relationship whatsoever. When you look at cost of production, as cost of production falls, profit goes up. Very strong relationship. Cost of production explains over 80% of the profit differences between herds over time. Getting back to these KPIs, kilograms of beef per AE, this is herd productivity, is a function of the reproductive rate, the mortality rate, and the sale weight. And look at this, only 17 kilos difference there. Reproductive rate, only 5% difference in that. Slight difference in mortality rate, and only another 20 kilos sale weight heavier. All very small amounts, and I for one can't see any great difficulty in moving from typical to top 25% in any of those, because the movement's very small. The thing is that they all have a multiplication sign between them. So when you improve all of them, you have more breeders, few of them are dying, you've got more calves born, sold at a heavier weight, and it's all multiplied up by the number of AEs you're running to produce that $90. Perspective. Might sound a bit harsh, but for those who've kept their pencils sharp, in the next 3 or 4 years, it's going to be an opportune time to expand. And whether you look at this on an individual business basis or on an industry basis, it is a crying shame that the evidence is that 80% of the producers out there don't seem to have a good handle on running a good business. But it creates an opportunity for those that can. And the things that I've tried to highlight so quickly in this brief presentation that you need to do are not difficult. We know how to do them. They can all be done at low cost, and they make the transformation between a business that won't be there in 20 years' time and a business that will. Recommendations, broad ones to finish up. Improve financial literacy and debt management, and I'll put in a plug for the Business Edge course. We've had somewhere between 30 and 40 courses run now, and over 400 individuals have gone through those courses over the last few years, and I think that's the starting point, to do one of those 2-day workshops. Number 2, you've got to understand what the profit drivers are, and they're all centred around productivity. Number 3, it says the same thing essentially, concentrate on income increase driven by productivity. We have to sit down and draw up protocols for the first time ever. It's never been done before. We have to draw up protocols that give producers in the north guidelines on how to deal with failed season risk at a lower cost, because a true drought or just a failed wet season is costing the average northern beef business far more than it should. We've got to manage labour-related expenses, and the best way to do that is labour efficiency. So I'm here to say that your target should be 2,000 AEs per full-time equivalent. Don't try and go much further than that. Once you go over 2,500 AEs per labour full-time equivalent, things start to fall apart. The R&M gets not done properly, and animal husbandry gets slack and all of that sort of thing. But around about 2,000 AEs per full-time equivalent's where you should be. And finally, I think that's the final one, A special plea, especially for those in extensive areas, please go and get a long-term safe carrying capacity assessment done by a competent rangeland ecologist on your place, and whilst they are there, ask them to do an assessment of the amount of A, B, C and D condition score land that you own, and stop flogging the C and D stuff. Resurrect it and get its productivity back up, and look after the A and B so its productivity doesn't slip. And I think, Mr. Chairman, I'm done. Thank you.